This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Lawrence McMillan. Larry has been managing money, educating professional investors, and providing insights and analytical tools to self-directed traders for over 20 years. He's been in the biz for decades more. Larry is the original, or shall I say one of the original, I'm sure some would argue the original, options education pioneer. He is instrumental in helping so many people over the decades to understand the vehicle of options. So for all of you out there that think, I only discuss trend following, come on. I will go for any interesting topic on this podcast. Our conversation jumps right into where he is talking about his past experience with Bell Labs. I hope you enjoyed this conversation with Larry McMillan. So you're at Bell Labs, and for those people that don't know about Bell Labs, I mean, this is, a lot of famous insights came out of there from the Kelly criteria. Claude Shannon was there. So a lot of brilliant people out of Bell Labs, right? Mm-hmm. Yeah. So why don't you talk about, so you mentioned, you say, well, I had access to a computer, and now listen, at that point in time in history, you're sitting there crunching this brand new options valuation model, and you're using this technology. I don't want the audience to think this is something where there was a lot of people doing this. There had to have been a fairly small minority of people at that point in time with the computing power access and the knowledge of the models themselves.
Right. Yeah. I would say, I knew a few because I was at Bell Labs, but those guys are mostly just interested peripherally. I mean, I never really considered myself a research scientist, even though I was sort of in that area. A lot of the research kind of scientist guys, they understood the model, and, we had computers there that you could access. Even in those days, we had, terminals on our desks at the labs that we could access computers with. I probably was a while, really, until I made some contacts with some people in Chicago that were kind of doing the same thing that I was until I really met somebody that was doing kind of similar work. I mean, I knew there were people, and obviously these articles were being published, but the articles weren't easy reading either. You really had to be kind of a math major to understand the articles. And in fact, when Fisher Black published the article in the Journal of Finance, he only did it, I think, just to answer some questions that people had about American-style options versus European-style options and how to treat dividends and things like that. So it was, I'm sure for him it was like mundane, but for the rest of us, it was sort of necessary in order to be able to construct the model correctly.
Options are always an interesting conversation because there's first the technical expertise of understanding the instrument, how it operates, but then there's the strategy element. So early on, was it a tremendous fascination with this new instrument, or were you early on also immediately looking at different types of strategies as well? Talk about how that was unfolding for you.
For me, when I first looked at it, I don't know, it just seemed like a logical thing to me that I could do two things. I could buy this one and sell that one and create this profit area. And then, I didn't really have to predict where the stock was going to go, but maybe just kind of in general, it was going to go up or down, or, if it went up a little more than that, I would do better. So I just started, on paper, messing around with these various strategies. And at that time, there was only one strategy book that I ever remember reading. It was by a guy named James Clunan. I don't know if you ever heard of him, but he eventually later became the head of the IIAA, which is like an Individual Investors Association of America, or whatever that is. And he sort of denounced options later in his life. But he had written his book on actual ratio spreads. And that's the first time I got into the concept of naked option writing. I thought, well, this makes sense, or naked options part of a spread anyways. And so then I just kind of expanded on that. It was a very thin book. It was maybe 50 pages. So I started coding up these various things, and, with the aid of the model, then it seemed pretty logical to me that you'd try to find a strategy that had a theoretical edge to it, as best you could. And so I started a little newsletter in 1975, maybe 74, that I was publishing really from my house. And Ivan Boesky was one of my subscribers.
Now, hold on. You might, as you say that, though, I mean, I'm old enough to know and have paid attention to Wall Street enough. And I believe he had a Time magazine cover at one point in time, but I don't know if it was for good news, was it?
Right, probably not. But in those days, he was less.
He was the Gordon. He was the caricature for Gordon Gekko, wasn't he?
Yes, definitely.
Yeah.
Mm-hmm. But so I mean, it was an interesting time. Everything was kind of being just invented. Options, quickly we went into that 1973-74 bear market. So options got very expensive. In fact, they were terrifically overpriced for much of that time. It was just a really interesting time. And then as time went by, of course, people started to figure out more of the mispricing, and they got involved with, selling options that were overpriced. And pretty soon, things got back in line, or things got in line, I would say. So you don't really find those kind of situations much anymore, where it's just, the entire option universe is, relatively mispriced.
As we weave our way up to current day, let me ask you about a few historical moments in time. Frankly, the one, I'm in my mid-40s, but for me, 1998 seems like the other day, but I guess it's not anymore. It's been a few years. But 1998, the summer of 1998 was a pretty momentous time, especially for options guys. And when I look back at long-term capital management, I'm curious your perspective. Was it more of a model error and a trust in the models, or was it just bad betting on the part of LTCM?
To me, they made a big strategy error, I thought. We do, I'm sure pretty much anybody who trades professionally or quasi-professionally does some sort of pairs trading, or, you see one market's overpriced with relationship to another market. And to me, we do a lot of that. And to me, it's always best to use options in that market, in that situation, because if you're wrong, you still can come out smelling like rose if both markets move. I'm just say, for example, just say you were trading, I don't know, Exxon and Chevron or something like that. But you, instead of buying one and selling the other, if you bought calls on one and bought puts on the other, then if both of them go up to the upside and say the differential between the two does not come in like you thought it was going to come in, you can still make money because the put you bought is going to, have limited loss, and the call you own will keep going. And in long-term capital situation, they made a huge bet on that the spread was going to improve, and it didn't, of course, and just about took them under. And I had no idea if they could have had how big the derivatives they were huge. I don't know if they could have bought that many derivatives, because I'm not in that over-the-counter derivatives market, which is basically in those days was Morgan and Goldman and Solomon. But if they had been able to construct it with options, they probably would have not only avoided the total disaster, but would have also been able to, come out of there with a profit, perhaps. That's always been my take on what they were doing, but I guess Yeah, that wasn't in. I don't think that they really were derivatives people at all.
Let me bring one more incident up and come up a little bit closer in time to even 08, 09, and we start to have this pretty volatile period in the fall of '08. And a lot of news reporting, I say this with nothing but respect, but clearly Warren Buffett has built a fantastic business. But I think it's interesting that the myth sometimes, or what people think he does, is quite different. And Warren Buffett's firm, they've sold a lot of options. I mean, they have no problem going in and utilizing option strategies as part of their overall plan, do they?
Right. Yeah, they do a lot of that. Yeah. In fact, wasn't I just reading even recently that he was he short so many puts or something like that when the market had that correction in October there was actually a little bit of consternation going on. I mean, no one would really think of that as a major correction. I'm talking about October of 2014, but no one would think of that as a major correction. But he's got enough short puts out there that the value of his portfolio was heavily affected by that.
Because I think it's something for many traders still, there's a certain education in options. And as you say from the very beginning, it required some math homework, but there's a certain education required. And so I think it's interesting to bring up stories where people can at least relate to and say, Buffett has an option strategy. I did not know that. And perhaps spur people to start to think more about it. Before we bring it up to some of your strategies and the ways that you use options, I'm curious also, one more kind of issue that's been all the rage in the last 4, 5, 6 years, which is the VIX. Why don't you go ahead and play professor for a second and talk through the VIX? Because on paper, it looks great. And it looks, whether you're, the options or whether you're buying an ETF comprised of the VIX, it looks great on paper. Like, hey, I can buy this insurance policy for the next October of '08. But I think a lot of people have getting killed in the VIX in the last 5, 6, 7 years, haven't they?
The VIX was first invented formally. Everybody had their own version of it. I mean, I remember all the way back, nearly 40 years ago, I was trying to do a little composite premium indicator or something. But the formal VIX was created in 1993 by Professor Whaley at the behest of the CBOE, Professor Whaley out of the Fuqua Business School at Duke. In fact, he just got the Sullivan Award for option achievement this year. Anyway, so it was a simple formula using OEX options, and everybody just looked at it, but you couldn't trade it. In 2003, then, Goldman pressured the CBOE to come up with a new formula that took into account all of the VIX options and was deep out of the money puts, which are very expensive. And so that became the new VIX. Since then, it was changed one more time last year. They changed a bit of the way it was calculated, so there's actually the newest VIX. You can quote all three, but they're all pretty similar. But the interesting part was in 2004, they listed futures on the VIX. It turns out that all of these derivative products that you mentioned, the ETNs, the ETFs, the futures, the options on the future, whatever, they don't really track VIX. VIX itself is such a complicated calculation, and it involves 2 strips of S&P options that it can't be duplicated for arbitrage purposes. And as a professional trader, you know that if a market can't be arbitraged, then the market makers won't take big positions and you have no liquidity. Like regular options, if a guy comes in and buys a ton of options and the market maker sells them, he can go in and take an offsetting position in stock and perhaps an offsetting position in a put option if he just sold a call option, and he can create a riskless position and, protect himself. So in the VIX markets, the market maker said, look, we can't do this because there's 2 strips of options here. And actually, let me just back up 1 second. The way the VIX is designed to be a 30-day volatility estimate. They use 2 strips of SPX options to calculate it. So the futures, potential futures market maker said, we can't arbitrage that thing. I'm not going to put on 2 sets of strips of options, and then every day the quantity of those options changes because the factor, the weighting of those two strips in the VIX formula changes every day. The CIBO and others said, okay, what if we just tie the futures to one strip of options? And the market maker said, okay, we could live with that. So we can do one strip of options against a futures position that we just had to take down, and we'll hold it to expiration and get out. Well, that's fine, except that's not VIX. And so in the reality of trading, VIX will rise much faster than the futures will. So the futures in a disastrous situation, let's say, take the day that S&P was down 80 in August of 2011.
It doesn't deliver what people think it's going to deliver, does it?
Right. The VIX went to 48, and the futures went to 32. Okay, you're hedging part of your portfolio that way, but you're really not hedging the whole thing. And in a lot of cases, they'll say, oh, well, I think volatility is going to increase by next year, so let me buy some VIX options for next year or something like that, or buy the VIX futures at 9 months out. That also doesn't work. It's a 30-day volatility estimate, so there's longer-term volatilities tend to just move slowly because no one knows what volatility is going to be 9 months from now. Short-term volatilities tend to move all over the place. That's the crazy movements you see in VIX. So if you want to simulate VIX, you have to, the best you can do, you can't do it exactly, the best you can do is stay very short-term and keep rolling it over. If you're trading the futures, you just stay in the front month and keep rolling them over. If you're trading in the options, you stay in like a 1 month contract and you just keep rolling it over. Eventually, if VIX does explode, you'll get a big chunk of that move, not the whole move, but you get a big chunk of it. So, like in 2008, the example I usually give is when things are kind of normal and copacetic in August of 2008, before the Lehman Brothers, thing blew up. VIX is running about 23, 24, and, the futures were about the same price. Then the next month, in September, when VIX blew up, VIX shot all the way up on the first move, and it was shot up to 54. The futures didn't go that high, but you got about, I'd say you got about 80% of that. If you were in the September contract, then the October contract, when it expired, you got, instead of the 30-point move, you got 20-some points worth of move. I mean, VIX eventually went all the way up into the 90s at that time. But the point was the February futures, which are just 5 months out, they only went up 6 points, and that wouldn't have protected you against much of anything. So there's a lot of complications to the product, and it's useful, but you have to know what you're doing. And I didn't even really get into what they call the term structure, but the term structure is the relationship between the various futures, and every day, if it's in a bull market, it slopes upwards. So one of the more popular volatility ETNs is the VXX, which was invented by Barclays in 2009. And that's trades, millions of shares a day. Everybody seems to like it. But in the reality of the situation is if you had shorted VXX on the day that it came out, you would be up 99.6% right now. They just keep reverse splitting it. And that's strictly due to the term structure of the options, which is something that really the retail doesn't understand that. And I think a lot of professional traders don't even quite understand it.
Well, it's been positioned as the black swan option, black swan protection option. It just doesn't work that way, does it?
Well, if the black swan event ever came along, yeah, I guess it would. But you can lose a lot of money before that happens.
Yeah.
Yeah, so what we do is, we buy them as a hedge, but deep out of the monies, we buy them as a hedge, and we don't really, spend a lot of money on them. They're just there for, like you said, black swan, for disaster protection.
Speaking of black swan, let me ask one more opinion of you, given that your experience in the option space forever. So I can think back to, and speaking of the author of The Black Swan, Nassim Taleb, and so early on, he's an options guy. Then it moves on to Mark Spitznagel. And, essentially they're just saying, let's buy all these out of the money options and let's just wait for something bad to happen. That strategy has worked well for them. But why don't you talk about the pros and cons of that type of strategy?
Well, first of all, I don't think I could trade that way. So it's something I think you'd have to have your mind wrapped around that and to do it properly. even they've run into problems recently that, it's just been so long since there's been a black swan event. I mean, in most of these markets that it just, hasn't worked. I would never really do that because I would prefer to trade a strategy, let's say, where you can make a decent amount of money. Let's just say you're going to sell puts. Puts are a wasting asset. You just sell puts. And then, you can hedge yourself against the black swan event by buying some, say, deep out of the money VIX call, something like that, but you would spend less on this than you would spend on the puts that you're sold. So that overall you're taking in a credit every month, and that's your profit. As far as planning on a black swan event, I mean, I'm pretty sure everybody thought after 2008 and then the flash crash in 2010 and even the problems of 2011 that we would have certainly had another one by then.
Let me let you go into your world, and you come at this more from an all-weather perspective with options. Why don't I let you explain your strategy from an all-weather perspective?
We call it volatility capture, which is sort of a misnomer, I guess, but it's really, our objective is to essentially, we're selling puts on the S&P 500, which are typically out of the money puts. Typically those are overpriced. So if you're using Black-Scholes model or anything else like that, those will generally show up as being overpriced. The reason is that, I guess, between the black swan traders and just everybody else kind of generally being nervous about the stock market could fall, they overpay for those puts, and they've been overpaying for them since the crash of 1987. So there's nothing new. So we sell those puts, and then we try to hedge ourselves. So in one way, we hedge ourselves by buying some other puts with a higher strike, so that we have some protection at the top. But again, I don't want to spend all of the credit that I took in from selling these puts on those other puts. So that helps us a little bit, and we can make money in a sideways to down market. In fact, if the market goes down just a little bit, we actually make quite a bit of money because we've got those puts at the higher strike. But our overall risk control is that we buy fairly deep out of the money VIX calls every month. They're about 7 points out of the money, which means they have a delta of about 20 or even less. And so most of the time we just lose on those. But it's like your house insurance. You don't really want to collect on the fire insurance on your house, but you can't be without it. That's the way, I view this. So we have this, and it's an ongoing cost of protecting ourselves. And in the back test, we've been trading a strategy for about 5 years, but we did not trade it live. We just traded it in our newsletters in 2008, and the hedge actually made quite a bit of money in 2008 because the disaster did occur at that time. So I'm not counting on disaster. I don't want there to be disaster. I don't want my house to burn down, but I do want to have insurance in case it does. So that's our basic strategy. So we're net sellers of puts. We take in credits, and if the market goes up, we keep all those credits. The market goes down a little bit. We not only keep all those credits, but we make some money on the extra long puts that we have. And there are nuances of which expiration we use, which striking prices we use, how much leverage we use. We trade it both with futures accounts and non-futures accounts. So futures accounts have a little more leverage because typically people doing that are a little more accustomed to having leverage.
Hey, Larry, let me ask one last question. I'm curious, just a big picture question. So here you are in the early 1970s. You get involved extremely early, not only having the technical understanding, but the ability to test and to calculate right there at the early stages. Talk about where we are. Maybe that's not the right way to say it, but just talk about where we've come from. Obviously, this is very new, almost over 4 decades ago. And then where are we today? Where do you see the progression of options? Are we at a good place, a bad place? I'm just trying to get your overall, sense of, you've seen many decades of this. So where are we in the life cycle, so to speak?
I have a very firm opinion on this. I think it's rather disappointing that it's still 40 years later, most people would be hard pressed to tell you the difference between a put and a call, or to tell you really what either one is. That's a big negative on the whole industry, I mean, but somehow or other, most people have not bothered to learn about options or have a misconception about options. To me, it's a shame because they are so versatile. They're good for protection. They're good for speculation or whatever. As far as the option industry itself goes, I mean, I think it's made a lot of advances. I think all of these new products they've come up with, including volatility options and, we didn't have index options in the beginning. Those have proved to be very profitable. So, or popular anyways. I think that, the industry itself is trying to move forward, but they've somehow or other missed the boat on educating a large group of people, the vast majority of people. I don't know if you agree with that or not, but
I think there's some truth to that. I mean, and as you said from the very beginning, it does takes a little more effort, so to speak, a little more mental acuity to dig into. It's not as simple as just buying and selling. It requires a little more effort for sure.
Right. Well, I think stock trading does too. Most people just don't realize it. They just turn on their TV and there's a guy there telling them, well, yeah, this company's, they just came out with a new movie and it's great. So buy Disney. Or don't you think everyone else in the whole world also knows that? It's like, why is that an edge?
Fair point. Hey, Larry, where can we send everybody to check you out? Where's the best website to send them to?
It's optionstrategist.com. There's just one S in the middle there, so it's optionstrategist.com.
Hey, listen, I appreciate you taking some time today. Wish you all the best of luck. Let's pray for some black swans, huh?
Okay.
Okay, take care. Michael. See ya. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.